Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of LifeMoves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of LifeMoves Wealth Management may maintain positions in the securities discussed in this podcast. Hey there, welcome to the Financial Purpose Podcast. This is episode 74. Great to have you here. If you're listening, thanks for listening, watching. Thanks for watching. Today, I'm going to talk about, and this is going to be an investing topic, and specifically how to identify and go about value investing. So I get this question periodically, and there's specifics about value investing that make sense. And then there's something that people do that they think is value investing that is absolutely not value investing. And I want to talk about those differences. So I'll tell you first what value investing isn't, and then I'll spend the rest of the time talking about what it is, what to look for, how to do it, how to be successful with it. Value investing is not buying penny stocks or buying stocks that are lower than $2 or something like that. That is called speculation. That is not investing. That's not value investing. So what we're looking for here are assets that have true value but are underpriced by the market for a variety of reasons. And that's what we're going to get into today. So because the market misprices stock, there's opportunities for arbitrage if you know what to look for. So we're going to talk about some key metrics or things that you want to look for how to spot the companies or the assets in the market that are undervalued. We're going to talk about certain parts of the market that are ripe in these current conditions for value investors. And I'm going to talk about some industries and some types of stocks that you might want to be wary of or stay away from due to high volatility risk or even potentially permanent and total loss. And that does happen sometimes in investing. So we want to make sure that we can avoid that by knowing what to look for, managing our risks appropriately. So let me start by defining what a value stock is, since I already talked about what it isn't. And a value stock is basically any stock that is trading at a discount relative to its intrinsic worth. So I just said a lot of word salad. It's a stock trading at a discount in relation to its intrinsic value or intrinsic worth. So let me talk about what that means. The intrinsic value is the true fundamental value of a company based on its actual financial assets and future earnings potential, rather than what the stock market in general or even investors think it's worth at any given moment. So you're going to calculate this by looking at the revenue and profits. So is the company making money? That gives it some intrinsic value. How much real cash flow is it generating? That gives it some value. What about assets and liabilities? What assets does the company own, versus the debt that the company owes? And the growth potential. What does it look like over time? What are they producing? Who is the buyer? Where are they going to get traction? Right. So you want to think of an intrinsic worth or an intrinsic value kind of like a piece of real estate. And you're going to go look at this house or this plot of land, and you're going to determine if it's worth what the asking price is. And if it's worth a fair value, then you probably will buy it at fair value or try to negotiate a little bit of a discount. If it's valued over its asking price, then you probably have a pretty good deal there. If it's valued lower than its asking price, then you're going to stay away from it. And so what we want to look for are the opportunities where you might have some ability to think about things like location and the quality and the potential appreciation before you decide whether or not to invest. And so what we're looking for here is stocks that are trading below their intrinsic value, meaning that it is priced lower than what it's actually worth, and there's room for that value to grow over time. All right, so a couple of key financial indicators, and this is like if you're a little bit of a stock nerd, or you want to be, or you're thinking about researching, or you're looking at a stock screener, because a lot of people do. And so if you're this person, Write these down. These are going to be things that you're going to look for, and I'm going to give you a couple of little tools that you can use, most of which are free to just go use and look at and start to get yourself familiar with. These are the key indicators that you want to look for when we're shopping for value companies. First thing we're going to look for is a lower price to earnings or PE ratio than the industry average. So here's an example. If we're looking at, pick your industry, let's say industrials, let's say construction equipment. Let's go even further down and say something along the lines of like a John Deere or a Caterpillar or an Ingersoll Rand or something like that. We're looking for heavy equipment manufacturing, let's say, or farm equipment, that kind of thing. If the industry average price to earnings ratio is, let's say, 22, and you are looking at any of these companies, and I only named 3, there's a bunch more. You're looking at any of these companies and you find some that are currently valued at maybe 15 times earnings or 12 times earnings or 9 times earnings or 18 times earnings, anything lower than that 22 average for the whole industry, then you want to start looking at these companies to find out why it's underpriced. And so a lower price to earnings ratio is key because it means that you possibly have an asset that is trading below its actual value, or it has the ability to make up room to come to a higher earnings to match the rest of the industry. So that's what you're looking for. That's the first sign of a discount. Second is a low price to book ratio. And so this is what's the book value, the asset value of the company, and what is it trading for compared to that ratio. If it's trading below its actual asset value or it's trading below the book value, you've got yourself a deal there. And again, these are all things that you can find on stock screeners, or you can Google, or you can put into ChatGPT or DeepSeek or any of the other AI models that are out there. They can pull this information for you and get very sophisticated and very precise on which companies match these criteria. Number 3, strong free cash flow. I'm a big fan of free cash flow because it shows that a company generates enough cash to not only fund its growth and return value to shareholders, because it enables them to have options. And so a company with high free cash flow can pay a dividend. They can buy back stock, which raises the stock price. They can expand, which adds to value over time. They can go out and acquire a competitor, which is accretive value. And so there's a lot of great things that happen with free cash flow. I love free cash flow. It's a hallmark of good value investing. Next, you're going to look at the debt to equity ratio, just like on your personal balance sheet. Lower debt means more financial stability. So if you find debt ratios that are very manageable and very low, those are the companies that you want to go for, because it means that those, again, are companies that are generating strong cash flow but maybe trading below their value. Now you want to look for number 5, high return on equity or ROE, and a high return on invested capital. And the reason you want to do that is because it means that you have a good management team. So if you're getting a good return on the money that's being deployed and put to work, you have a good management team that understands how to use money, not only to make investments, but also to generate efficiencies in the workforce to produce at a higher level that drives their costs down. And when management's running a company that way, it's going to increase the earnings potential. And then finally, for this section, there's probably a couple more indicators that you can look for depending on other sources of information. But I also like to look at insider buying activity. And you can see this on, again, any stock screener. So if the executives of the company and the management of the company, because it'll tell you exactly their names and when they're buying or when they're selling. But if executives are continuing to put their own money into the company and they're buying shares of the stock and management is buying shares of the stock, that means that they are seeing long-term value in the company that they are working for. And so they will basically be investing in the fruits of their labor. If you see management and executives selling at a high level, then you want to look at why they're selling. Sometimes it's for tax purposes. Sometimes it's because they had vested restricted stock units and they needed to take them out to buy a house or pay a tax bill or something. So there could be various reasons. You just want to look at that. But if you can continue to see a pattern of insider selling, then it's probably not a company that you want to be investing in. And that's true for value stocks, and that's also true for growth stocks. You want to definitely pay attention to that too. Okay, so when it comes to value investing, there's a couple of approaches that you may have heard or may be familiar with. These are certainly approaches that I have read a lot about over the past 10 years for sure. And so there's the Warren Buffett approach, which we would consider possibly one of the greatest value investors of all time. A lot of people say that about Warren, but I would say let's not forget about his longtime partner, Charlie Munger, who also fantastic investor, very, very smart guy. And we lost Charlie last year. And I would say it's hard to have Warren without Charlie and vice versa. To me, they're hand in hand. But anyway, the Warren Buffett approach is, or I could say the Berkshire Hathaway approach is to look for companies with strong moats. Think about a castle that's going to have a wide moat and a deep moat, and that means that they're not going to be as easily penetrable. And the same thing is true when you're looking for these companies. You want somebody that has a wide competitive advantage that will protect them from being overtaken by competition or fast competition. And in an AI-driven world, that's becoming a little bit more difficult to do with technology. But there are still some places where you can find a good moat, not only an economic moat or a wide gap, but definitely a competitive one, and that's what you're looking for. Benjamin Graham's approach. Benjamin Graham wrote a book called The Intelligent Investor. It was the first serious investment book that I ever read. Warren Buffett was one of his students. Ben Graham's approach is buying stocks for less than what they're really worth, which is what we're doing here. And the book goes through a lot of ways to pencil that out. And some of it is still current. The book was written a very long time ago. I want to say like 1950s, 54, 56, somewhere in that range, if I remember correctly. But a lot of that still holds true. And so he's looking for strong companies with low debt, steady earnings, and they leave a margin of safety, free cash flow, to reduce risk. There's another book that I read a long time ago called The Little Book That Beats the Market. It's by Joel Greenblatt, and he has what he called a magic formula for finding undervalued companies, and it focuses on buying good companies at bargain prices. And you do this by ranking stocks based on, number one, a high return on capital. I just talked about that a couple of minutes ago. It means that the company and the management is very efficient at taking money and turning it into investment that leads to profit. The second thing that Joel Greenblatt's book is looking for is a low PE ratio, price to earnings. So again, talked about this a few minutes ago. You want to look at an industry average and then find companies that are trading below the industry average. Do a little bit of research to find out why. And when you combine those two factors, right, so a high return on capital and a low price to earnings, you can consistently set up a screener on most stock platforms, and you can find undervalued companies that have strong profitability. And those companies, when you make investments and you hold them for a long period of time, I'm not talking about trading. Nothing that we're doing here when we're value investing has anything to do with trading. We're buying companies, we're holding them for a long time. That's the Warren Buffett approach too. That was the Benjamin Graham approach. That's the Joel Greenblatt approach. And for clients of Life Moves Wealth Management who are listening, this is the Smead Value Fund approach as well. This is where those guys got their roots steeped in, is value investing from guys like Ben Graham and Greenblatt and Munger and Warren Buffett. This is what you do. You find the companies that are trading at a discount. You pick up the arbitrage, you hold them until they reach their growth point, and you do that for a long period of time. And then you have a buy-sell discipline that says, This is the criteria I'm looking for when I buy. This is the criteria I'm looking for when I sell. And you want to do those so that way you're not caught up in the emotion of what's going on, but you understand that sometimes the market's going to give you factors or the company's going to give you factors that will interrupt your buy-sell discipline. But I've talked about buy-sell discipline on the podcast before. It's incredibly crucial to be an investor, to be successful as an investor, to hold companies, to hang on to them, to continue to invest, to buy more shares when the value goes down. If you still believe in the investment thesis and the reason why you bought the company in the first place, you tend to have higher returns that beat the market over time. Okay, so screeners that you can use to find these stocks. I have used all of these. You can use FinViz, FINVIZ. Seeking Alpha is a good one. Morningstar is industry leader. Value Line is a great screener. It's a little complicated until you kind of get the gist of it, but it's a great one. I still use FinViz. I still use TradingView. I still use Simply Wall Street. There's a lot of different. You can use Zacks. You can use. I already said Seeking Alpha. I mean, there's a lot of screeners. You can use Fidelity. You can use Schwab. You can use. I mean, there's just a bunch of different places where you can look up stocks. There's apps on your phone. I mean, the Apple, when you get the phone, it comes with a stock app preloaded, so you can screen there as well. Another thing you can do if you really, really have a lot of time on your hands and you really want to understand more about certain companies that you're researching and following, you can look for the company's SEC filings, SEC, Securities and Exchange Commission. You can listen to their earnings calls because those are public, and you can get kind of an idea of what's going on with the company. What is the CFO, CEO, COO, what are they saying about the company? What are they saying about the direction they're going? How are they guiding earnings going forward? And that's how you can understand if your screener points you to the direction of a company and you go listen to their earnings call or you pull their SEC filings where you find a transcript of their earnings call and you can see that they might say, hey, yeah, sales have been down. The market's been trading us kind of low, but here's what we're working on. We're making investments into this new product or this new facility or this new program or whatever, and we expect that it will increase earnings by X dollars or X percent per share over the next 5 years. Well, now maybe you have yourself a story, something that you can invest in and get in early before it becomes a hotter stock in 2 or 3 years, and that's value investing. There's a service that you can use called Quarter. And because we're in the modern era, we drop letters for everything. So this is spelled QUARTR, Quarter. And that's a service where it kind of works like a podcasting platform. You do have to pay for it, but it'll pull in all of the earnings calls for all of the companies that you can think of. It aggregates them, and then you can listen to them directly on the platform. So that may be something to look into as well. Again, if you have the time to listen to analysts or listen to the company earnings calls, that might be a great way to pick up that information. Okay, second section here. I want to talk about sectors that offer good value opportunities, and then I'm going to talk about places you might want to stay away from. And so this is important because I may mention various companies. I may mention certain sectors to both invest in or consider investing in or not. And just remember that this podcast, as you heard at the very beginning, is not investment advice. If you have specific questions to your financial situation, please reach out to me. I'm happy to talk through what might make sense for you based on your financial goals, your risk tolerance, all of those things. And you can always send an email to info@lifemoveswealth.com and just ask for a phone call, or you can go to lifemoveswealth.com and click on the schedule button and set up time with me. And again, non-investment advice, myself, this podcast, Josh, the producer, or Life Moves Wealth, none of us are responsible for any action you take based on what you hear today. So that said, Here's some sectors or some industries that have potential for good value. So based on the current environment, and this will shift based on what's happening around the economy and geopolitically and all that. So right now we still have higher interest rates. We still have the Fed paused on cutting interest rates because they raised them, arguably not high enough and not soon enough, but now they're cutting and they're kind of stuck in a. I think they're in a pickle. Personally, I think they have been in a pickle for 2.5 years. Actually, I think that they've been in a pickle for probably 8 years, if I'm being honest, for a lot of reasons. But anyway, they can't directly cut rates right now. Inflation is back up to about 3%, and it looks like it might just keep ticking just a little bit higher, especially at this turn of the year. Corporate earnings still continue to be good. Unemployment is down to about 4%. There's a new administration. They want the rates cut immediately to go with the potential for tariffs. Meanwhile, they want to cut taxes, right? So we have all sorts of things going on that aren't really complementary to each other, that are kind of like mixed signals for the economy. But the economy remains resilient. The consumer is still spending. Eggs. I bought eggs over the weekend on Friday. We went camping over the weekend, so I bought a pack of eggs, and it was an 18-pack of eggs, and it was just a little over $8, and it pissed me off because I'm almost at the point where if eggs are going to be $8, I need to get some chickens or something, right? So we're just in a weird spot. That $8 for the eggs, I still bought the eggs, and I enjoyed eating my $8 eggs. And every time I cracked one, I said, "Oh, here's another $8 egg. Here's another $8 egg. Here's another $8 egg." Which again doesn't make sense because the egg itself wasn't $8, but we're not that far from it, right? But anyway, the consumer continues to spend even with some of these higher prices, even with a little bit of inflated prices on things, even with massive increases in things like car insurance and home prices and mortgage rates and payments and things like that. We're still chugging along just fine. So industries that work in these kinds of environments, definitely financial services, banks and insurance companies. Banks with solid balance sheets can benefit from higher interest rates. Why? Because they're able to take money on deposit, invest it, produce a return, lend out money at a higher rate. And so they themselves are getting an arbitrage based on what they're charging you versus what they can make. It's a great situation for them. And I personally, in this case, I think a lot of times, the bigger banks are kind of natural because they do have the bigger balance sheets. They can buy back stock and things like that. But regional banks tend to be more value oriented here. They tend to be the stocks that are a little more underpriced. And you can do a search for regional banks that are publicly traded and run them through your stock screener. And same thing with insurance companies. There you want to look for larger insurers because you need the stronger balance sheets with an insurance company, which you want to make sure that they're not an insurer that has too much risk exposure because of things like hurricanes and wildfires and earthquakes and anywhere where there's a high claim area. Even, the driving behavior, as an example, in a given city, if you have a high insurance concentration there, you're going to open yourself up to some risk. So you're going to look for, again, regional banks tend to be underpriced. Insurance companies can be underpriced. You want to run them through your stock screener. Another place is healthcare and pharmaceutical companies. Because we have such a large aging population, this is going to continue to be in demand over the long term. And long term, I'm saying really over the next 10 to 20 years, we're going to see higher healthcare costs come through the system. And so good healthcare companies are going to make it. I'm not necessarily talking about the healthcare insurers because there is a little bit, I think, of a fight brewing with that sector of the industry. But I am talking about things like medical devices and surgical providers and beds and wheelchairs and knee replacements and surgical tools and high-tech surgical things. those companies tend to do really well. And same thing for, big pharma, good established biotech firms that are accomplishing, and they're putting R&D money into things that we're going to be dealing with a lot more, like dementia and arthritis and things like that. Cancer is an interesting one because cancer drugs can be boom or bust. But there are some companies that are still doing that very well, and they have established things in place, and it looks like we should continue to see people need to use those drugs. So you want to look for those. The next one is going to be what we call consumer staples. These are defensive stocks. These are things that you have to buy. These are companies that sell essential goods like food, hygiene, household products. So, examples here are going to be things like Procter & Gamble, Coca-Cola, Pepsi, Walmart, things like that. Those are going to be companies that do it. If you're, I'm not sure about, I'd have to relook at the financials to give you names there. For healthcare and pharmaceuticals, you would want to look at companies like Medtronic or AbbVie or, possibly Bristol Myers, any of those companies that are in that vein. And what you often can do is even start with things like KeyBank and Fifth Third Bank and I'm trying to think of another one. A couple of them we lost in 2023 when Silicon Valley Bank went out. And so I was in 2023, that was last year. And so you can often start with those banks and then find its competitors or similar stocks and then set up your screeners for those. So those defensive stocks, the consumer staples, those tend to hold steady even in times of economic pullback, dare I say recessions. And that can be a great thing to do. The next place where you might look, number 4, is industrials and infrastructure. These are companies that manufacture essential equipment that run transportation networks. These are things that even the government uses it as infrastructure spending to kind of stimulate economy. So again, going back to things like, if we need to stimulate the economy, maybe we do infrastructure projects that are government funded. So now we're going to need heavy equipment, and we're going to need tools, and we're going to need machinery, and we're going to need workers and outfits and trucks and nails and screws and things like that. So you're going to be looking at, again, the John Deeres, the Caterpillars, the Fastenal tools, there's a lot of those kinds of companies. You can look at which companies are manufacturing the heavy vehicles, provided that they haven't already over-manufactured, right? That's key. But you just start thinking about how that's going to work and start looking at companies in that sector. And then finally, energy. And this is mostly going to be oil and renewables, which, again, is not a popular statement at the time. But oil and gas still make up most of the energy production and supply in this country. And that's not changing very fast, very soon. So advancements in things like solar can be helpful. Wind, I'm a little skeptical on. There's a lot of environmental issues with those, in my personal opinion. We don't yet have the battery storage capacity to have that be a great source of energy because, again, you have to use oil and gas to mine and manufacture the products that make the batteries that run all this stuff anyway. So we're not breaking away from oil and gas anytime soon. And if rates are high and borrowing costs are high and inflation's a little bit higher, and economies are still resilient, we're probably going to see oil prices remain relatively steady, but some of those companies are going to remain cheap to their earnings, but you just have to be mindful that it's a commodity, and commodity prices can swing at the whim, literally, of OPEC or production cuts or anything like that. So you definitely want to be thinking about that. But renewables are a great long-term play, but you've got to be patient with them. And so, again, for clients of Life Moves Wealth, this is one of the keys of the SMED Value Fund that we own that I really like, is because they understand oil and renewables and real estate and goods and things like that, infrastructure. They've got a pretty good philosophy about it. And again, you go to smeadcap.com, you can get all of their literature. I'm not endorsing them, but I am saying, full disclosure, that clients of Life Moves Wealth own this fund in the core investment portfolio, and this is why. This is exactly right up the alley. Okay, companies that you want to be careful with because they're volatile or they can be risky is number one, high-tech growth, especially companies that don't have profits. Now, where this gets wonky is in 1997, 98, 99, 2000, right? We could have said this about Amazon. Amazon famously was unprofitable for a long period of time, and Jeff Bezos was, back when he still had hair a little bit, and he just kind of looked like, like a total, kind of small guy, small posture, small voice. Now he looks like Vin Diesel, right? But back then he didn't. And you probably could have said, stay away from this company, but had you invested in the original early shares of Amazon and rode the volatility, and continued buying, you would be incredibly wealthy at this point. So you have to, again, run it through Screener, know what you're looking for, understand what the company's trying to do. But many speculative tech firms, there's a lot of great ideas, especially right now in the AI generation, but they often don't have sustainable earnings, and that makes it difficult to invest. You might trade them, but not invest. There's a difference there. And you want to be very careful about companies that are trading based on pure hype. So, if you look at a company like, let's say, NVIDIA, as an example, traded like crazy over the past 2.5 years. A lot of it was on AI hype. But you have to remember, we came out of a period where chips were in high demand and low supply, and NVIDIA banked a lot of back orders that never got canceled. And so they're still producing and still selling, and their earnings are up. And so the stock price justifies the value, or I should say the value of the company and what they're doing justifies the stock price. But there are some companies that kind of catch on the coattails of that and have nothing to offer and are very unprofitable startups, especially in the AI space, and they end up failing. Second sector that you want to be careful of is biotech startups, early stage pharmaceuticals. FDA approval is a mother effer for some of these companies. Many of these companies never make it, and sometimes it's on really stupid stuff. And even well-established pharmaceutical companies don't pass their FDA trials. And so you want to make sure that you understand where the company is in their trial stages, what exactly their drug is supposed to do, and what value it's going to serve to the market, and who the end user is going to be, and whether or not they're likely to get FDA approval, and if their blind tests are going well, and all the studies and the research is coming back favorably. You definitely want to look at that. And so this is where you want to use large, diversified healthcare companies that aren't dependent on the R&D of one drug to make their whole portfolio. So you definitely want to pay attention to what else they're making, how well that stuff is doing, how well established it is, how long it's been in the market, what it's providing, all of that. Next one is EV startups. We've seen several EV companies go completely under. They came out, they maybe made a vehicle or two or 5,000 and completely just lost momentum, or they had fraud. A great example of this, unfortunately, is the company Nikola, which had a great looking product and came out and then completely fell apart. So these are going to be companies that are capital intensive. They have a very, very high burn rate because of how much it costs to make these vehicles. And they have a lot of competition right now. So a great example and a major exception, just an absolute story for the ages, is Tesla. Elon Musk, like him or not, Tesla is an amazing company that's had the craziest bit of luck and hard work and just paid off, and mass adoption to the public, where a lot of EV companies have struggled to get market share. And so you definitely want to look at the newer players that are coming out, if they have good adoption rates, if they have sustainability, if they have the the capacity to go more than 17 miles on a charge, right? You definitely want to look at stuff like this. The next place, this is going to be a wildly unpopular statement: cryptocurrency and blockchain stocks. These things are extremely volatile, heavily driven by speculation, no fundamental intrinsic value. So I talked about intrinsic value at the start of the episode. There's nothing, they don't own anything. It's not backed by anything. It's basically, I've said this before, I'll say it again. It's no different than the dollar bill or $20 bill or $100 bill that's sitting in your wallet right now. It's not backed by anything. It doesn't own anything. There's nothing supporting that value other than that we agree, and the federal government backs up based on their full faith and credit that it's worth whatever it says on the paper. So not all that different, but you're not likely to lose all your money by having dollars in your wallet. You can lose all your money by converting those dollars to cryptocurrency or blockchain driven stocks. And so you have a high risk of permanent loss of anything that you invest. I mean, just look at recent examples. Look at Melania Trump's coin. Look at the Haktua coin. What's her name? Haley. I can never remember her name. But whatever that coin was, same thing. There's been so many of these over the past 5 years, where people invest, the coin value goes way up and then it just crashes. And if you bought it at the top of the peak, you lose so much money. And usually it's not all that different than a Ponzi, sort of, where people who got in early watch it right up and then they just start pulling their money out because they got a bunch of suckers to continue to buy. And so if you're buying those things, there's a good chance that you will be the sucker holding the end of a very empty bag. So you want to be absolutely careful there. And then number 5, also going to be unpopular with a completely different sector of people, but unproven green energy technology. Man, that's really, really difficult. But things like hydrogen and batteries, it's just very, very, very tricky. And I was just reading an article today, great example. There was a company called Core Power that was scheduled to build a very large plant in Goodyear, Arizona, which is a suburb to the west of Phoenix. And it was going to provide lots and lots of jobs and millions of dollars in revenue, which turns into investment success for their employees and for themselves and for the market once they go public and all this stuff. And that ain't happening. And so if you were an early stage investor in something like that, it's something that's green power driven or battery power driven, and they're a battery manufacturing plant. It just very much can be a place where money goes in and you never see it again. So you want to be very careful there. So let me give you a couple of key takeaways as I wrap up here. First, you want to stick with companies that have strong fundamentals, great cash flow. Again, I love free cash flow and a lot of it, and they have a good wide moat or a competitive edge. And again, run the screener. I'll give you those factors one more time that you want to look for. And you're going to run a screener. Sorry, going through my notes here. You're going to look for low PE or price to earnings ratio, low price to book ratio. Again, you can Google these or throw them into your AI tool or any of your stock screeners. Number 3, free cash flow. Again, high free cash flow is ideal. A low debt to equity ratio, a high return on equity, and a high return on invested capital. And then finally, you want to look at insider buying. So if you can pay attention to those factors, those are the companies that you want to look for. And you want to look for companies that are trading below, based on their earnings, they're trading below their industry average. You want to, as another takeaway, avoid industries that are prone to extreme volatility, extreme hype, or heavy regulation risk. That's absolutely something that you want to be mindful of. And that goes back to the pharmaceutical companies and things like that. Highly regulated, very much can kill any investment potential for growth in any of those areas. And I would say personally, be very wary of anything that has to go through the FDA to make money. Just saying, that's my personal opinion. Okay. And then key takeaway, every time I talk about investing, patience is key, especially when you're value investing, because it's about long-term growth and long-term high returns, not quick wins, not fast home runs. That's not what we're doing with value investing. This is not trading. We're looking for companies that are selling at a discount. We want to buy them and let them grow and let them mature and let the price come up, because that's going to give us better returns long run than if we're constantly trying to cycle them through. So again, use your stock screener, know what you own, know why you own it, know for how long, know what it's supposed to give you in return, right? So set a target and then know what your criteria is for making an exit. And that's investing in anything. That's what you should do. And again, investing and trading, two totally different things. We're talking about investing here. So start using the stock screeners to run your own analysis. Read the earnings reports. Understand the company's fundamentals. Understand what management's trying to do. And it's going to help you make good decisions there. And then, again, just stay disciplined. Don't try to chase the hot stocks. Don't chase things that lack financial strength. Don't chase things just because the stock price is low. Just because the stock price is low does not mean that it's underpriced. So you can have a stock that trades at $10 or $13 per share, but it can be wildly overpriced based on what it is and what its intrinsic value is and what the industry is in the sector. So just make sure that you're not looking at underpriced assets based on dollar amounts. You've got to look at the earnings, and you have to look at how many times earnings are you willing to pay for what they're doing, what the company is producing, and what they're planning to produce in the future. All right, so I hope that is helpful information especially for all you value investors, or for anyone who's been curious about value investing. This is kind of just like a high flyover primer. If you liked this information, share it with somebody, whoever you talk about investing with, at the party, over the neighbor fence, around the water cooler at work, wherever you talk to people, whoever's talking about investing. This is a great episode to share. Everybody's going to learn something, and it's going to give you the opportunity to make some money if you're willing to be patient and buy the right companies at the right prices. And again, I'm not talking about timing, and I'm not talking about trading, right? Finding undervalued assets and buying them when the price is in your favor. It's arbitrage. You're buying it for less than what the market thinks it's worth. You're going to have good results long term. Subscribe to the podcast if you aren't already. Share the episode. Leave a review. That would be very helpful to me as well, and I would appreciate just a quick thumbs up. Leave comments. I do answer comments. So if you leave a comment on a podcast or on any of the YouTube stuff, I will answer and start a conversation. You can follow me on LinkedIn. That's probably the fastest place to get my attention. And you can also follow Life Moves Wealth on Instagram, and that's at Life Moves Wealth. And on LinkedIn, it's Dale L. Schaefer the second, I think is how it's Dale Schaefer the second. You can find it. So anyway, look me up, connect with me, send me messages. I will answer, and I look forward to that. So until next time, go be financially awesome and take care of yourselves. See you later. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.